In this presentation, we'll be covering the rules and showing test results for the trading market's high probability ETF trading strategy known as RSI 25. RSI 25 is a long trading strategy, and it's built on the RSI indicator. In particular, we're using the 4-period RSI, RSI being the well-known relative strength index. The default period is 14 for that indicator. We're going to use 4 for this particular trading strategy. So we're looking at just 4 days for RSI. We're looking for a pullback during a long-term uptrend. And when these two rules are met, when the close is greater than the 200-day moving average and the 4-period RSI is below 25, we'll buy the ETF on the close. The purpose of these rules is to identify a long-term uptrend and a short-term pullback. For more aggressive traders, we'll want to add a second unit if the 4-period RSI closes below 20 on any day after the trade is opened. A second unit can be defined in terms of shares or dollars. If you're trading $100 or 100 shares, you would add 100 shares using this more aggressive strategy. If you're trading a $10,000 unit size, you would add $10,000 as your second unit. Now, because this is a high probability trading strategy, adding to positions on additional weakness should increase profitability, and we have test data that we'll share with you showing that it does. To exit the trades with either version of this strategy, you'll sell your long position at the close of the day when the 4-period RSI closes above 55. Here's the original trade results that were first published in 2009, and subsequent test results confirm the strategy still is effective in the current market. On average, these trades gained a little more than 1% and were held for an average of 6.2 trading days. More than 3/4 of the trades were winners. Using the aggressive version of the trading strategy, more than 82% of the trades were winners. And this version also increased the average gain to nearly 1.5%. Here's an example of this trading strategy. We see the 200-day moving average at the bottom here, and we see a slight pullback in the ETF. The 4-period RSI confirms the weakness when it closes under 25. You buy on the close that day and hold until the 4-period RSI closes above 55, which in this case occurred 4 trading days later. For the aggressive version, again, we see that this ETF is pulling back while above the 200-day moving average. After the trade is entered, it pulls back further, and this is confirmed by the 4-period RSI. That means a second unit is added, which in effect lowers the cost basis for the trade. When the trade is then closed, the profit of the trade is increased significantly over time. In summary, the RSI 25 strategy, built upon the 4-period RSI, is a high probability, low frequency trading strategy. We encourage you to explore this and other trading strategies available in detail on the Trading Markets website. You should be able to find the right combination of strategies that allow you to take advantage of any market conditions.